everybody I know has made money from one trend: rates. Rates going lower, low volatility, massively liquid, massive leverage. So you can take liquidity preference because you're in the most liquid thing on earth. You've got time preference because rates are going lower from demographics, deflation, technology, globalization. And you can take risk in that trend because you've got leverage. So that was the biggest generator of alpha for the entire macro industry forever. The other generator of alpha is FX. Mass liquid markets. Problem is the FX trends have been getting more muted over time. As we moved into the WTO agreement, before WTO, countries used to use tariffs. And to offset the tariffs, you have to let your FX move a long way. So if you look at the charts of DXY going back to the 80s, it would go up 100%, down 50%, but it's got much more subdued because everybody's now using monetary policy to try and weaken their currencies at the same time, which is one of the reasons gold goes up and Bitcoin goes up. Now, as I mentioned earlier, I'm worried that dollar stays within a range. And many of these major currencies, if you look at the Japanese yen for the last 30 years, it's basically been pinned in a range around 105. It goes up and down cyclically, but doesn't go anywhere.
Right.
So if we've got a range between currencies and the IMF are trying to push people towards a range, this new Bretton Woods movement, well, that's the death of FX. The bond market's going to go to roughly zero, trade sideways for 20 or 30 years. I don't buy the secular inflation, hyperinflation story. I think it's Japanification driven by demographics, debt, technology, and globalization. So if rates go nowhere, that alpha's gone, the biggest market on earth. Credit, same, because the Fed have now backstopped the credit market, so you can't make a lot of money out of credit. So credit's gone, bonds have gone, apart from cyclical trades, and FX may be cyclical as well. So you've got no secular bull market, bear market, or anything in any of these. That is the death of macro.
Okay.
It is beautiful. And equities are not macro instruments. You know, if a bond is 80%, 90% macro, and 10% emotion, positioning, equities are the opposite. They're like 10% macro and 90% noise. So that makes it very hard. So that pushes you out to emerging markets, which can be macro, and it pushes you into crypto, which also can be macro. So let's go to that world. So you are massive CalPers, right? You're CalPers. And bonds now offer no protection, no returns. You don't get much from FX risk, and FX isn't going anywhere. Equities are wildly overvalued in the US, and there's no juice to be had from credit, right? But you've got this ticking time bomb of your pension holders. You need to deliver them a return. Your answer has to be emerging markets, because you need to find returns. Now, Indian bonds, 6%. India is an expensive stock market, but with that demographic, the chances are it could triple or quadruple from here. So you don't get that opportunity. And Grantham Mayo, they produced that, expected future returns. Expected future returns of developed market equities are negative, developed market credit negative, developed market government bonds negative, emerging markets positive. Well, we don't know whether there'll be a secular shift away as they move to digital money and other things. But gold is historically, Middle East and India, all of those nations that I talked about are big gold holders. Right. It's very much cultural. So yes, I think at the margin, it's powerful for gold. I think the gold run goes for quite a few years. It probably won't outlast emerging markets, but it'll probably do another 5 years from here. Time horizon matters.
Okay.
So my crypto bet is the next 12 months.
I see.
My crypto bet is that it's going to destroy every other asset on earth performance-wise. And it's going to suck everybody in on a massive reflexive loop.
Yes.
The more the market cap goes up, the more the institutions need to buy it because they need to not lag behind the institutions that already bought it. The more it goes up, the more retail buy it. Becomes a very reflexive loop.
Yes.
So that is too powerful. I look at the charts of Bitcoin versus every asset and it's basically eating them all. So that will play out. And as you've said before, we know how these things end. They end up in a bear market for a while. That's normal. It's just human behavior. It's how markets work. No market goes through big bull phase or a big bear phase without a massive reversal phase for a while.
Yes.
So what I'm trying to do is set up a time horizon for people to understand is, okay, this is my bet for now.
Yes.
May not like the crypto bet, so start looking at the emerging market bet, but I still think there's 6 months risk window here that I wouldn't do the trade.
Okay.
So I'm saying 6 months risk, crypto may or may not have a correction it should do, but just an ordinary correction, and then it should explode.
Okay.
Emerging markets, if you can buy them into a sell-off, fantastic. That will set you up. You can go to the beach and forget about it.
Yes. Got it.
Then, as that trend reestablishes and it starts proving itself, you go further out into the risk curve. So you start going into India and you start going into other markets. Gold should get taken along most of that ride too. So there's a whole phasing here. So, yeah, I know people get confused, but I see things in future expected probabilities. And there's a path to get there. The path isn't everything all in now. It's like, this is the phase for crypto. We're at a risk phase for markets. That risk phase for markets will set us up for emerging markets because the dollar may go up first. Then let's say the dollar stabilizes or weakens. Emerging markets will take off. It'll start sucking in equity market capital out of the US system. So that's how I see it. We also need to move away from the dollar because it's 80% of the world's trade is in dollars and only 25% of the world's GDP. There's a problem. There's not enough dollars around. So when things go wrong, everyone's starved of dollars. It's unfair for, let's say, Brazil to be beholden to the US dollar when its main trading partner is China.
Right.
Why do we need this middle currency? Right. Yeah. So the Brazilian economy goes up and down according to the dollar. This is untenable. So what you need is to change the mechanism. So the IMF are talking about baskets of currencies, whether it's trade baskets or let's say a commodity basket currency based around, China, Brazil, South Africa, Canada, Australia. You make it so you've got a basket that suits commodity producers. That can happen. All of this stuff can happen. The other thing they've talked about is the Bretton Woods moment where, look, in 6 months' time, we're going to be talking about a fiscal stimulus of some order of magnitude that we can't get our heads around now. Because if I'm right, this insolvency continues and the COVID issues continue for a while, government's going to be forced to do something bigger. And the IMF said, what we should do is coordinate it. We should get everybody to do it at the same time so it doesn't destroy anybody's currency.